Oh, okay. Um, so, good afternoon, everyone. It's back to our discussion. Um, so today we're going to be talking about something very important and with respect to key finance, and this is particularly for those who are into banking and finance law area of practice, and those who have interest in that area. So we're going to talk about a very key aspect of finance, and we're going to and that basically has to do with bridge financing. Okay, now we'll go straight ahead and discuss in its simplest term. So bridge financing is a form of temporary financing intended to cover a company's short-term cost until the moment when regular long-term financing is secure. So take for example a company um, is looking to get some inflows, let's say by the end of the month, and between the first day of the month to that end of the month when the inflow is expected to come in, they will need some monies to shore up their operations to handle some other issues. So they take a facility for that 30 days period, right? So it's more like a bridge between now that you don't have money till when you have money. Always a short period of time. So that money comes into cushioning the effect. So that's basically what bridge financing is. Okay, so the name as it sounds implies the meaning. All right, it is named a bridge finance because it acts like a bridge connecting the company to debt capital through short-term borrowings. All right. Now, an institution, like I said, that urgently needs capital to meet its short-term obligations. For example, working capital. A company runs short of funds, and they need working capital to quickly work on a couple of things. So they go for a short-term loan, which we refer to as bridge financing. All right. So the summary of what I've said basically is a bridge financing is a short-term financing which is aimed or geared towards providing funds to companies until they obtain long-term financing or until they are able to lay hands on cash that they're expecting. All right. So that's basically bridge financing, and usually it is very expensive given the risks associated with such type of loans. You should already know that the riskier a loan is, the more the interest rate. So when we say a loan is expensive, it means the cost of the loan, it means the interest to be paid, the cost of servicing the loan is very high. And bridge financing, and that's always one of the disadvantages because of how short the term is and how risky it is always very expensive. Now, let me just put it clearly and in simple terms. How does bridge financing work? There are many ways a company can secure bridge financing, and the options will usually depend on the borrower's credit profile and the borrower's history. That is, the company borrowing the money, the history, the financial history, and the financial profile, the credit record of that company. More options are available to the company with a solid credit history and market position, and one that needs a little short-term credit than a company in huge financial distress. So a company that is having issues even repaying some other debt or that have been constantly restructuring may have difficulty accessing bridge financing because the expectation for bridge financing is that we give it to you and then you repay within a very short period of time. So you don't want to give that opportunity to a company that is in financial distress, right? So when does a company need financial bridge financing? When exactly does a company need bridge financing? This is a clear example. Now imagine a company, let's say LAG Nigeria Limited, right? Has a loan that has been approved for the company. Let's say the loan is in the amount of $1 million. So the company LAG Nigeria Limited applied for a loan for a facility of up to $1 million, and the facility is granted. to the company. But the facility is tranched. In one of our videos, we talk about tranching. It is tranched, meaning it consists of different parts. Let's say two, or let's say four parts. So the $1 million comes in four parts, in four tranches, in four installments. The first tranche, maybe coming in 6 months, right? The first tranche comes in 6 months. Now, between the date, the first date, between the current date and the 6 months, the end of the 6 months, when the first tranche becomes available for the company will definitely need some money to run one or two things, to working capital, maybe to pay salaries, to buy stationaries, to do a couple of things. The company will need that fund for that short period of 6 months before the first tranche comes in. And of course, when the first tranche comes in, the company can use it to offset the bridge financing it took. The bridge financing that gave it breath, that gave it oxygen within that short period before the first tranche came in. So when the first tranche comes in at the expiration of 6 months, it can apply the sums gotten from that first tranche to settle the bridge financing it got. All right. So it's basically a very simple thing, but as the transactions come in, each transactions we would therefore be taking on a case by case basis. So you have to look at the peculiarity of the situation, the credit worthiness of the borrower company, and the negotiations around what the interest rate would be. Like I already told you, bridge financing are always very expensive, but it's more like this is the last option the company has, right? It's expecting monies in the future, but it needs money right now. So it's more like the last option, and to get that, you will have to show that you have a good credit record and be ready to bear the high cost that comes with it. So that's basically what bridge financing is. If you have questions, you can drop it in the comment section below, and also write us to give you further explanation of how all of these things work. Thank you.